In this revision video, we're going to spend a few minutes thinking about some of the key factors that drive labour productivity. Well, labour productivity is one of the most important factors in determining a country's living standards, relative living standards, indeed within the world economy. And labour productivity is basically a measure of efficiency, how much output is produced for a given input, such as output per hour worked or output per person employed. Now, historically, labour productivity has grown by around 2% per year, but actually over the last 15, 16 years, indeed in particular since the global financial crisis in 2008 onwards, labour productivity has risen much more slowly. And the gap between productivity in the UK and other leading economies has widened. In 2023, ranked on GDP per hour worked, the UK came only fourth highest of the G7 nations, United States highest, Japan lowest, and the UK has about a 20% productivity gap with the United States. So here's the chart showing economic output per hour worked in the UK, an index there for the UK, and you can see that the sharp fall in productivity during the financial crisis, the turbulence during the pandemic, but essentially productivity has flatlined. It hasn't really increased very much at all in the last certainly 3 or 4 years, but actually the growth rate's been weak in the last 15 years. So what drives labour productivity? Well, I think fundamentally it's about capital. Do workers have the machinery, up-to-date, cutting-edge machinery that is needed to increase their efficiencies? So infrastructure matters, investment in infrastructure, be it transport networks, telecommunications, connectivity, energy systems. Proper infrastructure lifts productivity. That's true for both advanced and developing nations. Weak infrastructure, aging, decrepit, obsolete infrastructure hampers productivity growth. Likewise, companies that invest sufficiently in new machinery, new plant and equipment, new technologies can over time increase their productivity. Now, in the UK, there has been a lack of investment. Capital investment as a share of GDP lagging at around 15, 16, 70% of GDP since 2008, well below that of other leading countries, and that's contributed to slower productivity growth. Human capital, the labour force, the quality of your labour force has a big impact. So education and skills clearly matter. If you have a highly skilled, educated workforce that is able to adapt and utilise new technologies quickly and effectively, that drives productivity up. But gaps in skills, especially in STEM fields, data science, digital skills, etc., can also hold back productivity growth. And a lot also depends on the quality of on-the-job training and lifelong learning programs within businesses, within organisations, to enable people to adapt to changing technologies and changing job needs. R&D, innovation, is obviously really important going forward in long-term factors driving productivity. So investments in research and development can lead to new products, better services, new processes that enhance efficiency. Now, the UK does have some particularly strong sectors. Think life sciences, think pharmaceuticals, obviously think financial services, but many other industries lag in areas of R&D investment. And the UK does invest relatively little in R&D as a share of our GDP, certainly less than 3%. The adoption of technology also matters. So the diffusion, the spreading of existing technologies, including artificial intelligence, in theory can boost productivity. So it'd be really interesting to see the extent to which the UK embraces and adopts AI across a sufficiently wide range of industries. Certainly barriers to technology adoption can stem from regulatory challenges and also a lack of infrastructure. So will Britain have the physical capacity for data centres and bandwidth to be able to fully embrace the potential from artificial intelligence? And then often, if we think about a whole country, often productivity is dragged down by regional factors. So you often get quite big regional disparities, differences in infrastructure and investment between regions as well as within them. Obviously, in the UK, we have this persistent north-south divide, and often that can hold down productivity growth. The underperforming areas and regions can act as a drag on the whole economy. The economic geographers amongst you will understand the potential from urbanisation and agglomeration economies of scale. So urban areas, densely populated, locus attractive to talent, can benefit from agglomeration effects where businesses and workers in close proximity can boost innovation and efficiency, particularly in industries related to ideas. And then obviously at an international level, the extent to which countries are open to trade and investment does matter for productivity. So, I mean, the UK is a relatively open economy. We always have been a trading nation. But certainly if you think about different countries, opening up access to international markets allows businesses, in theory, to benefit from economies of scale, exposing them to global competition, and also open to investment. FDI can then bring an influx of capital, new technology and expertise, lifting productivity. Now, again, the UK since 2016, it's a little bit early to say, probably, but post-Brexit, that kind of uncertainty has made the UK perhaps a little less attractive to FDI, and there has been a fall in export intensity in the UK. And this chart on the right-hand side here is the latest kind of figure for the productivity gap, adjusting for purchasing power parity. The UK it lies below the United States, Germany and France. Not massively below France and Germany, but some way below others. Italy, Canada and Japan actually on this measure some way below. That's put GDP per hour in US dollars with a PPP adjustment. So the relatively weak productivity growth in the last 15 years, there's many factors, lots of papers are being written about it, but essentially it's about a lack of investment. The UK economy overconsumes and underinvests. And that underinvestment in capital infrastructure, we see it on a daily basis. Our ageing road network, our creaking transport system, our power grids that are close to capacity and so on and so forth. Our telecommunication system that is getting there, but not quickly enough. R&D spending has fallen as a share of GDP, and there's been a cut in innovation rates in some sectors. I would argue that economic uncertainty, including Brexit-related disruptions, have discouraged investment. And of course, in the labour market, whilst unemployment is low, labour shortages are high, particularly skill shortages affecting businesses that want to grow. And there's also a kind of long tail or a longer tail of underperforming firms. And there's quite a bit of work there on the quality of management and the impact that has. The UK economy does have a higher proportion of relatively low-skilled managers than other European countries, including, for example, Germany. So there we go, a quick look at some of the key factors driving this really important economic indicator, labour productivity. Thanks for joining in.